Hi guys, welcome back to my channel. This is Tim Ambrose here on Learn Trade and Forex. Just in case you're new to my channel, please click the subscribe button and the notification bell so you get notified whenever I post a new video. Also, drop your comments at the comment section, whatever you want me to explain more better. If you do not understand it clearly, drop your questions at the comment section. I would go through them, and if need be, I'll make a video in that aspect just for you to get to understand it clearly. So today I want to quickly explain the MT4 or the MT5 platform, how we use this to trade the Forex market, and terminologies you need to know as a Forex trader. So let's get to the business of today. Okay, the MT4, MT5 platform and Forex terminologies. Two things to cover number one, the time frame, the lot size, the pips, the bid and ask price, how to read Forex quotes, base and quote currencies, exotic currencies, cross currency, cross quotes, margin, currency acronyms, long and short positions. Those are the things we are going to cover in this video. Now the time frame. The time frame, this is the time it takes a candlestick to open and close. This is the time it takes a candlestick to open and close. And there are different time frames. On the MT4 and MT5 platform, you see the M1, which is the 1 minute, M5 5 minutes, M15 15 minutes, M30 30 minutes, H1 the 1 hour, H4 the 4 hours, D1 the 1 day, W1 the 1 week, MN the 1 month. If you are using a 1 minute time frame, every 1 minute new candlesticks form. So if you are trading the H1 every 1 hour, a new candlestick will form. So here is what I am talking about. Here you can see this is the H4 time frame. So I can as well change it to the H1. This is H1, which is 1 hour time frame. So it means every of these candlesticks you're seeing here represents 1 hour. You can go as low as 5 minutes. You can see how scattered it is. So the lower the time frame, the more the candlesticks. The higher the time frame, the lower the candlesticks. Lot size. This is the amount you are willing to buy or sell a pip. From the MT4 platform for trading currency pairs, this is the representation of the lot size. 0.01 is equals to 10 cents. That is if you're using a dollar account. That is your base currency is the United States dollar. So the 0.01 represents 10 cents. 0.02 represents 20 cents. 0.03 represents 30 cents. The 0.1 represents $1. 0.2 $2. 1.0 $10. And okay, so if the market was on, you would have clicked on this order and it would have brought out the volumes. That is where you impute your lot size. You set how much you're willing to buy or sell a pip in the Forex market. Now the pip is the smallest unit of change in which a currency pair can move. Okay, for better explanation, the Forex market, a whole lot of traders from different parts of the world trade the Forex market. And we come to this market with our various currencies. Those in the United States come with the dollar and the cent. The British come with the pounds. The Mexicans come with the pesos. The South Africans come with the rand. The Nigerians come with the naira. So there is a need for this market to have its own standard. So no matter the currency you come with from any part of the world, you get into the market, it is seen in relation to pips and pipettes. So no matter your currency, no matter how much you have, it is seen in relation to pips and pipettes. The bid and the ask price. Forex quotes are shown in bid and ask prices. The bid is the price at which the market maker is ready to buy a given currency pair. And so at this price, the trader or the seller can sell the base currency to the market price. The trader, that is the seller, can sell the base currency to the market price. So if you are selling, your sell will be initiated at the bid price. If you're buying, your buy will be initiated at the ask price. When we start with examples, live examples, you get to understand that clearly. How to read Forex quotes. Okay, let's go to this chart so I show you the bid and the ask. Okay, so this is the chart. So this guy we have here, this red is the ask price, while this white we have here is going to be a line, is the bid price. If you initiate a sell, it will appear on this white. Initiate a buy, it will appear on this red. So this is our bid price and this is our ask price. How to read Forex quotes. When quoting currency pairs, the first currency is referred to as the base currency, while the second is referred to as the counter currency. Now, counter currency or quote currency. For example, this is the Great Britain pounds against the United States dollar. So the GBP is the base, while the USD is the quote or counter currency. Here we have the euro against the Great Britain pounds. So the euro is the base currency, while the Great Britain pounds is the counter currency. The major and minor currencies. Forex major currencies are the 7 most commonly and frequently traded currencies, generating the majority of the global currency trading volume. In addition, the majors offer the most liquidity. The list of currencies below consists of the 7 major currencies. So these are the 7 major currencies we have in the Forex market. They are the most traded. That is why they are referred to as the 7 major currency. Any other currency is referred to as minor currency. Please take note of that. Also, we have the exotic currencies. In general, exotic currency are currencies that are not commonly traded in Forex markets. Exotic currencies are usually originated from developing countries from Asia, the Pacific, the Middle East, and Africa. Trading exotic currency is not simple, since the market does not offer the same level of liquidity. So we prefer to trade the major currency than the exotic currency. Please take note of that. Cross currency. Cross currency is a pair of currencies traded that does not include the United States dollar as one of its currency, whereby one foreign currency is traded for another without having to first exchange the currencies into the United States dollar. So any currency that does not include, any pair that does not include the United States dollar is referred to as cross currencies. The cross quote. The cross quote is the currency exchange rate between two currencies, both of which are not the official currencies of the country in which the exchange rate quote is given in. For example, if an exchange rate between the Great Britain pounds and the Japanese yen was quoted in an American newspaper, this would be considered a cross rate because neither the pound nor the yen is the standard currency of the United States. Yet, the exchange rate between the pounds and the United States dollar were quoted in that same newspaper. It would not be considered a cross rate because the quote involves the official US currencies. Margin. The margin is the amount of money needed to open or maintain a position in the Forex market. Please don't just hit a high lot size or initiate a trade when you don't have enough money to maintain that position. The market is not friendly. It will definitely not go in your favor immediately. It may play a little bit before it begins to do what you think it was going to do, or what you know it's going to do. So you need money to be able to hold that position. Currency acronyms. All currencies have an internationally accepted three-letter acronym. The first two letters abbreviate the country name, and the last is the name of the currency. For example, GBP is Great Britain pounds. So USD is the United States dollar. The first two letters abbreviates the country's name, while the last is the name of the currency. Now, the long and short position in the Forex market. When we talk about long, we're referring to buy or being bullish, while the short is to sell or be bearish in that market. Traders can make profits or losses regardless of whether a currency is rising or falling. For example, when a trader buys a currency like the Euro USD, they are said to be in a long position. You're buying, so that's a long position, or long euro in this case, and are hoping for the euro to increase in value relative to the United States dollar. So if you're long on the Euro USD, it means you believe that the euro is going to increase in value in relation to the United States dollar. So if you're bearish or you're short on the Euro USD, that means you're selling the Euro USD and you believe that the United States dollar would increase in value and the euro will depreciate in value. I believe you got that. Please don't forget to leave your comments below, ask questions, I will reply your questions. And if need be, I'll make a video to explain or answer your question properly. Don't forget to hit the subscribe button or the notification bell so you can get first-hand information or be the first to get notified when I post a new video. Thank you and God bless you.